So, is it possible to convert an investment or a rental property into a principal residence? Or can I exchange a rental into another rental, then convert it into a principal residence? And can I sell it a principal residence and reduce my capital gains?
Inconceivable. 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 Inconceivable!
Well, it is conceivable and possible as long as you follow some of the IRS rulings to avoid ending up with a large tax bill. Today's video will take a deeper dive into these questions, and if you stay put to the end, I'll answer a bonus tip of avoiding depreciation recapture on a rental property as well. I'm Harold Powell, a local real estate agent serving Ventura and the surrounding communities. And if you want to stay up to date on all things real estate for Ventura, then I suggest hitting the like and subscribe and bell icon for future content. So let's first address, is it possible to convert investment or rental property into a principal residence? Well, let's begin with establishing intent. When determining whether a transaction qualifies for the special tax treatment the IRS considers the taxpayer's intent. In other words, you must show that you originally intended to hold the property as an investment for business use or rental use, even if subsequently you changed your mind. Now, while the tax code does not specify a minimum holding period for properties, the IRS does grant safe harbor to investors who use a property as a rental for 2 years. Now, while renting it at fair market rate for at least 14 days per year. In addition, the property owner must not use the property for personal use for more than 14 days per year, or 10% of the days it's rented during each 12-month period. Now, let's dive into question number 2, which is, what if I sell my rental to purchase another rental that I later convert to a principal residence? Well, let's begin by breaking this question down, which is selling a rental to purchase another rental tax-free. Now, it's fairly common for investors to use a 1031 tax-free exchange to purchase a single-family or multi-unit residential rental property. A 1031 exchange is a way to sell your rental and buy another rental without triggering capital gains, as long as you follow the IRS rules. And there's 5 basic rules to follow for a 1031 exchange. Number 1, you must purchase another like-kind investment property. In other words, selling an income property for another single-family residence or condo or multi-unit that is also a rental income producing property. So number 2 is the replacement property must be of equal or greater in value. So you could sell one property for, let's say, $700,000 and buy 2 or 3 other properties for a total of $700,000 or more. Number 3, you must invest all of the proceeds from the sale. Now, you can choose to pull some of the proceeds from the sale, but that money will be taxed. Number 4, it must be the same title holder and taxpayer. Number 5, you must meet the time frame requirement. The time clock actually begins upon the closing of the relinquished property. From there, the investor has 45 days to identify the potential replacement properties and a total of 180 days from the closing to acquire the replacement property. Now, lastly, it's best to use a qualified 1031 exchange intermediary company to facilitate the transfer of your funds to the next purchase, because if the proceeds of the sale are deposited into your account, then it becomes a taxable event and you'll actually lose the tax-free exchange status. That would be a bummer. So now that you've done the exchange, at what point could you convert the rental property into a principal residence? Well, the same 2 rules apply as mentioned earlier, which are, number 1, you must show that you originally intended to hold the property as an investment or rental property. Number 2 is you use the property as a rental for at least 2 years. Now that that's been satisfied, now you can look at the third question, which is, can I sell it as a principal residence and reduce my capital gains? So once you've converted the property to your principal residence, you have the opportunity to take advantage of the primary residence exclusion rule. Now, this allows you to exclude up to $250,000 for a sole owner and $500,000 for married couples filing jointly of the capital gains on the property sale. Now, to qualify for this, you must have owned the property for at least 5 years and have used it as your primary residence for at least 2 of the past 5 years. The 2 years do not have to be consecutive to qualify. So it's notable that this exclusion only applies to the gains that were experienced during the time the property was used as a primary residence. So you must prorate the amount of gain between the time the property was held for qualified use as your primary residence and the non-qualified use as the investment. So let's take an example. After, let's say, 5 years of owning the property, you've lived in it for 3 years, you've rented it out for the 2 years prior, which would mean that 60% of the gain would be arguably tax-free up to the $250,000 to $500,000 threshold, depending if you're a sole owner or married couple. The remaining 40% is equivalent to the 2 of the 5 years, which is where it was an investment property and is considered gain and is going to be subject to state and federal taxes. Lastly, you would pay tax on any depreciation recaptured owed in this scenario. So the takeaway from this example is the longer that you use the property as a principal residence, the lower the taxable investment percentage you'll be subject to in the event of an actual sale. Now, the caveat is this assumes that the tax code does not change any further. And if the tax code changes further, obviously all these rules will possibly be off the board, so you'll definitely want to check with your CPA. So it's common for property investors to shift investment strategy. So if your plans include converting a 1031 exchange property into a primary residence, keep in mind that failing to show intent can lead to costly tax consequences. So we always recommend that you consult with your experienced tax and legal professional before making this type of change. And just be sure to document related discussions in writing, which may prove useful in case you are audited. And as promised, the answer to the bonus tip of avoiding depreciation recapture on a rental property is that depreciation recapture is again, another tax you pay for depreciating the property while it was a rental, and then you turn around and sell it. Now, investors may defer paying on depreciation recapture by turning a rental property into a primary residence or conducting, again, a 1031 tax deferred exchange. But when a investor passes away and a rental property is inherited, that property basis is actually stepped up and the heirs no longer have to pay tax on depreciation recapture or capital gains. Of course, again, check with your tax professional on all this information. I hope you find this video helpful. If so, give us a like. Thanks.